Now, looking at the baseline data, it establishes the fundamental state of the company as broadly stable, but notice the upward performance trajectory here. It maps directly to their corporate metamorphosis. We are quite literally watching a distinct structural evolution unfold in real time.
To objectively balance the potential structural upside with the inherent execution risks, here is what we're going to cover today. 1. The corporate metamorphosis. 2. The value chain ascent. 3. Building a financial fortress. 4. The bull case upside. 5. The bear case risks. And 6. The Q4 FY26 catalyst.
Let's kick things off with Section 1, the corporate metamorphosis. Back in August 2025, the rebranding from SMS Lifesciences to Haleos Labs wasn't just some cosmetic facelift. It marked a definitive pivot from being a legacy commodity API producer to a true specialty biotech entity. And with the 5-year trailing return of 136%, the market is absolutely pricing in this transition. The stock is actually approaching its 52-week high right now, sitting at just over 1,604 rupees.
So, what's the strategic why behind all this? Well, it's all about the structural mechanics. Haleos is actively exiting the high-volume, thin-margin world of legacy commodity APIs, where price erosion is just a constant headache. In its place, they're favoring a model built entirely on low-volume, high-margin specialty molecules. These have exceptionally high technical barriers to entry, which naturally means a much lower price erosion risk.
Moving right along to Section 2, the value chain ascent.
This value chain ascent maps out their progression perfectly. Step 1 relies entirely on their foundational WHO GMP manufacturing infrastructure. Then Step 2 moves them into securing dominance in niche therapeutic APIs. Specifically, we're talking about molecules for anti-migraine, anti-ulcer, and erectile dysfunction. All of this culminates in Step 3, which is the big one, breaking into the highly regulated, low-volume, high-margin orphan drug target markets.
And that brings us to the January 2026 catalyst, or what we're calling the HRV Global multiplier. Basically, by merging Haleos' WHO GMP manufacturing capabilities with HRV Global's robust regulatory execution, they are unlocking direct entry into the highly coveted US and EU orphan drug markets. Crucially, they have already initiated those US DMF filings.
Let's look at the numbers in Section 3, building a financial fortress.
The very first metric that really jumps out is his heavily deleveraged debt-to-equity ratio of 0.34x. That highlights a really strict fiscal discipline, which aggressively protects the balance sheet and gives them substantial room to maneuver.
Then you have to note the staggering 196% profit after tax growth they recorded in FY25. That figure fundamentally validates the highly lucrative margin profile of this new specialized product mix.
Reviewing the Q3 FY26 earnings, net profit rose 21% year-over-year to 6.65 crores, and that is built on a solid sales revenue base of 94.78 crores. Management is attributing this margin improvement directly to that higher share of specialty APIs we just talked about. Synthesizing these key financial indicators is what gives us this fortress view. You've got the 0.34x debt-to-equity ratio, a robust 9.12x interest coverage ratio, and of course, that massive 196% FY25 PAT growth. Under the leadership of Managing Director TVSN Murthy, this exact fiscal discipline prepares the company perfectly for non-dilutive, inorganic growth.
Now, management's strategy to deploy that capital relies heavily on an asset-light engine. By leveraging their existing infrastructure alongside the HRV collaboration, they're aiming to drive output up while keeping CapEx requirements incredibly low. The ultimate goal here? Accelerating non-dilutive growth to elevate their return on equity, which is currently hovering between 10 and 11%.
All right, Section 4, the bull case upside.
The objective bull case is built on 4 very clear structural tailwinds. First, there's the successful pivot to high-margin APIs. Second, the massive regulatory momentum they're gaining via the HRV partnership. Third, robust promoter alignment, with holdings maintained tightly at 72%. And finally, shifting institutional sentiment, which was marked by an April 2026 technical breakout yielding hold and buy upgrades.
But we have to look at both sides. Section 5, the bear case risks. To completely counterbalance the thesis, we absolutely have to detail the vulnerabilities. First up, the liquidity volatility that is just naturally inherent to microcap constraints. Second, a historical growth lag. Their 5-year CAGR is sitting at roughly 8.7%. Third, they have heavy revenue concentration in very specific niche therapeutic categories. And finally, the most critical one right now, geopolitical margin compression. Ongoing tensions in the Middle East are triggering global freight and energy surcharges that could heavily impact their bottom line.
Which leads us to our final part, Section 6, the Q4 FY26 catalyst.
If we map out the trajectory of recent catalysts, it shows a very clear sequence. It started with the August 2025 brand metamorphosis to Haleos Labs. Then came the multi-year HRV Global partnership in January 2026. Right after, in February 2026, Q3 FY26 profits jumped 21%. And all of this culminated in the April 2026 technical breakout, which triggered those major institutional upgrades.
That brings us to the ultimate strategic target, a valuation re-rating beyond their current 26x PE threshold. But make no mistake, this is dependent entirely on the Q4 FY26 execution test. The market is fully anticipating that their high-value orphan drug execution simply has to act as the primary margin shield against those geopolitical freight surcharges we mentioned.
So this leaves investors with the definitive question for this equity. Can high-value orphan drug execution successfully shield margins against ongoing geopolitical freight surcharges? The upcoming Q4 FY26 results will be the objective answer.